Hi everyone and welcome to a new video. In this video I'm going to share with you a dividend stock that's down more than 40% last year. They literally can't catch a break. But before that, I am not a financial advisor and this is not investment advice, of course. I already made a video about this stock, but since then the share price fell even more. The stock I'm talking about is none other than Dine Brands Global Inc., ticker symbol DIN. Dine Brands owns franchises and operates restaurants in the United States and internationally. They belong in the consumer discretionary sector and in the restaurants industry. Dine Brands Global has a small market cap, just over $400 million, $405 million to be more specific. Their current P ratio is very low, 4.42, and their forward P ratio also looks very good, 4.55, which means that they expect solid earnings in the future. Looking into their income statement, I can see that generally speaking, they buy back a lot of shares, giving back a lot of value to their shareholders, and since the share price is so low, this might be a very good time for them to buy even more shares, but we can't be sure, of course. We will see what they will actually do. Looking into their balance sheet, I can see that they have a huge debt, just below $1.6 billion, while their net cash debt is just over $1.4 billion. Debt could be a problem, but with good management, this is still manageable. As you see, they try to pay it off slowly, but you have to always keep an eye on it. This debt is no joke, it is huge. Now, my favorite thing about this stock is their dividend yield, which is 7.67% at the time of this video. So, for every share you own, you will get paid $2.04 annually, so 51 cents every single quarter. Another great thing about this stock is that they have a very low payout ratio. This is not something you see often, especially in stocks which have very high dividend yields. Their current buyback yield is 2.13%, which is something that we also like to see. And as I told you before, I'm waiting to see what they will do in this quarter. They pay dividends consistently, but the amount of these dividends changes a lot throughout the years. In 2017, for example, they used to pay 97 cents every quarter, while in 2024, they paid 51 cents every quarter. In the last 5 years, the stock is down more than 68%, which is terrible. There are a lot of good things about the stock, but the huge debt and the fact that the revenue is kind of stagnant keeps me from making this stock a big position in my portfolio. I'm not gonna lie, I really like their current valuation, and if the share price is below 27 during February, I might buy a few shares of this company. Analysts seems to have the same opinion with me about the stock. They can see that it has potential to grow, but the stagnant revenue, the huge debt, the uncertainty in this industry, and probably many other reasons we wouldn't be able to even consider, make their consensus hold. Their 12-month forecast for the share price has a low estimate of $32, an average estimate of $37, and a high estimate of $47. So they expect the share price to grow between 20% to 76%. Most of the times, the high estimate looks too far-fetched. But I don't think this is the case for this specific stock. I can't predict the future, of course, and these stocks involves a lot of risk. Of course, I will keep you updated. I will decide during February where I will actually invest. Let me know what is your opinion about this stock. Do you already own it? And also, let me know how is your investing journey going so far. Subscribe for more videos like this one, and thanks for watching.